The age-old debate, active versus passive investing. Which is better? I'm a financial planner and I'll give you my choice, why I believe it's best, and some pitfalls to watch out for. But before I disclose that, let's briefly discuss what active and passive investing are for those who may not know. First, passive investing is choosing an asset allocation. It could be a percentage of stocks and a percentage of bonds, or it could be something else. But once you have that asset allocation, you continue to buy into that asset allocation or continue to hold no matter what happens. How does that differ from active investing? Active investing is choosing investments based on a certain set of criteria or your expectations of how that investment will perform over your given time frame. And you're regularly changing those investments based on the changes in your criteria or maybe your expectations for the future. Most people associate active trading with day trading, trading options, picking stocks, but it doesn't have to be the case. Personally, if I had to choose between a passive strategy composed of ETFs versus an active strategy composed of ETFs, I would choose active every time. And here's why. The first reason I would choose active over passive is because passive investing underperforms by definition. Now, that might be a little confusing, so let's talk about why. It's because you will always be holding a loser. When you choose to passively own the entire market, by definition, you will have some winners and some losers. And because your strategy is passive, you will continue to ride that strategy out regardless of what's going on in the markets. For example, most financial advisors will encourage their clients to own an allocation of stocks and an allocation of bonds. And oftentimes within that stock allocation, they will recommend you own some US and some international. Now let's look at some numbers here really quickly. So we have two different portfolios here. One will be some US stocks and some international stocks. The other will be strictly the S&P 500, which is US stocks. All right, so from the time frame January 1997 through April 2025, this portfolio of US and international, right here we have the Vanguard Total Stock Market Index fund at a 70% allocation, and then the total international stock index fund at a 30% allocation. This is often an allocation that is commonly recommended. Okay, and let's compare that to the benchmark of the S&P 500. So over this time frame, if you started with $1 million in the US and international allocation and you passively owned that allocation, rebalanced back to it on an annual basis, here's what the ending balance would be. $9,089,457 for a compounded annual growth rate here in the third row of 8.1%. You also had a maximum drawdown of 53.26%. Now let's compare that to the S&P 500. If you started with $1 million, same amount, your ending balance would be $12,228,365. That's a compound annual growth rate of 9.24% and a maximum drawdown of 50.97%. So the difference here in performance, as you can see, is you get less upside performance and more downside by passively holding a 70% US stock allocation and a 30% international stock allocation, at least over this time frame from January 1997 to April 2025. Now, when most people see this, their logical conclusion is why not just own the S&P 500 and sit back and relax and not own any international stocks at all? The problem with that now is your stock allocation is concentrated to only one portion of the market. So what happens if we get a scenario where over the next decade, the international stocks actually outperform the US stocks? If that scenario were to play out and you're relying on a passive strategy, it will not adapt to the market conditions. Which leads me to my second reason that I believe an active strategy is actually better than a passive strategy. Active investment strategies can actually adapt with the changing market or economic conditions. And this can happen primarily in two ways. The first way is that active strategies can actually go to cash when things aren't looking so good, or just go to less volatile investments until things recover. And sometimes this can actually boost upside performance and offer you less downside, as you can see here. So as you can see in this performance summary, we have over here on the right-hand side the S&P 500 index fund from Vanguard. If you started with $1 million back in 1995, in January of 1995 to be exact, and you held all the way through May 22nd, yesterday, 2025, starting with that $1 million, your in balance was $21,686,090 for a compounded annual growth rate of 10.64% and a maximum drawdown of 50.97%. So that is the total amount that your portfolio has dropped at any given time. But if we apply some simple cash logic to that same S&P 500 investment, we actually get some better performance to the upside with a better downside as well. So as you can see here, this third column, we're going to ignore this middle one for now, but in this third column, we're using SPY, that is the S&P 500 ETF. If you started with $1 million, your end balance would have been $24,393,510 for a compound annual growth rate of 11.07 and a maximum drawdown of only 19.43%. And the worst year was negative 11.45 versus negative 37 on the S&P 500 if you just bought and hold. So what is this third column, this other portfolio, doing that is giving us better performance to the upside and way better performance on the downside? All that it's doing is looking at the performance of the S&P 500 over the last 12 months. If that performance is less than what cash could have earned you, then you hold cash. If it's above what cash could have earned you, then you hold the S&P 500. It's very simple and straightforward, and it's a very disciplined approach to make the decision of whether to go to cash or whether to continue to hold the S&P 500. So if you just followed that very simple trading strategy, you actually ended up with higher upside performance and significantly better downside experience that makes it way easier to continue to hold your portfolio and not make any changes to your strategy when your worst year was only negative 11 and your maximum drawdown was negative 19 versus negative 37 and negative 50 just on the S&P 500 with a buy and hold strategy rather than the active strategy that we're applying in this column here. The second way that active strategies can adapt with the market or economic conditions is it can actually change the investments that are held based on what areas of the market are actually performing and those that are not. And I can demonstrate that here through this performance. So again, we're going to ignore this middle column here that says equal weight portfolio, and we're only going to look at the S&P 500 over here on the right-hand side and this dual momentum model category here over on the left-hand side. So through this time frame of May 1st, 2014 through yesterday, if you would have invested in the S&P 500 or more specifically Vanguard's S&P 500 index fund, you started with $1 million, your ending balance would be $3.73 million. That's a compound annual growth rate of 12.62%. You also had a maximum drawdown in a worst year of 23.95% and 18.23% respectively. However, if we have this model change what's held in the portfolio based on what's performing most recently and not choosing to hold what's not performing, we actually see even more performance to the upside and still that downside protection like we saw in the previous performance summary. All right, so in this scenario here, we have a bunch of different ETFs that represent different areas of the market, whether they are in the US, large cap, mid cap, small cap, or they might even be international or emerging markets ETFs. And how we're making the decision of what to hold is we're looking back over the most recent performance period. In this case, it's 18 months. And whatever has performed the best over that time, that is the ETF we choose to hold. If the S&P 500 is below the return on cash over that time frame, then we are going to hold cash within that period until it recovers. So I know that might be a little bit confusing, but the point is this portfolio is able to change the investments it's holding based on what's performing, and it's able to go to cash again if things aren't performing so well. So, this specific performance here is a starting balance of $1 million, the ending balance of $4.48 million, and that is a compound annual growth rate of 4.49%. We also have a worst year in a max drawdown of negative 6.77% and negative 18.23, both better than the S&P 500 buy and hold strategy. And those are significantly better. This 2% outperformance here on the compound annual growth rate over this 10-year period resulted in almost $1 million more. If you looked at longer periods, this is constrained by the ETFs that I included here. But if we were able to look at this over longer periods of time, that higher compound annual growth rate would only continue to make this gap larger and larger. So, those two reasons are why I prefer an active strategy over a passive strategy. Number one is the ability to protect the downside and go to cash when things aren't looking so good. And number two is the ability to change the investments based on what's actually happening in the market or in the economy to best set you up for success. However, there are two pitfalls to watch out for with active investment strategies. The first pitfall to watch out for of an active investment strategy is tax drag. This is the drag on performance of the tax liability that you will owe by actively trading in and out of different investments and realizing the gains that you are making. However, this only does apply to taxable accounts. Trading within retirement accounts like a traditional or Roth IRA does not incur taxes on the realized gains, dividends, or any interest you receive along the way. The second pitfall to watch out for with active investment strategies is an emotional bias of the person who is actually executing the strategy. Emotion is an active trading strategy's worst enemy. So it is important to seek an active trading strategy that is disciplined and is based on factual data. If this video has piqued your interest into upgrading to an active investment strategy that one, can protect the downside, and two, actively adjust to what's happening in the markets and in the economy, then you can check out our active strategy that we've built called Fluvius. We've shared a complete breakdown in another video on my channel called A More Intelligent Approach to ETF Investing. We dive into how the strategy works, the logic behind it, and the performance numbers compared to the S&P 500. And I gotta admit, most people are shocked by what they see. So if you're interested, go check out that video. But that is why I would choose an active investment strategy over a passive investment strategy every time.